Look at this picture. You buy a neat residential building, collect rent checks every single month from a line of happy tenants, and sit back as the cash rolls steadily into your bank account. On paper, it sounds like the absolute golden holy grail of passive income. It feels completely simple, elegant, and virtually risk-free. After all, every single human being on Earth needs a roof over their head, and housing is one of the most fundamental, non-negotiable necessities of modern civilization. But here is the brutal, terrifying reality that nobody warns you about before you sign a multi-million-dollar commercial loan document. Owning a housing business is not simple. It is not even close to simple, because what looks like a landlord casually collecting rent checks on the first of the month is actually a multi-layered, high-stakes financial operation that touches real estate law, commercial banking, liability insurance, property management, tax strategy, and local government regulations simultaneously, 24 hours a day, 7 days a week. Most people who walk into this industry have no idea what they are actually stepping into. They buy into the popular social media narrative of effortless passive income, believing that physical real estate is an automatic money printer. They discover far too late that a housing business does not care about your financial dreams, your good intentions, or how much you paid for the property. Today, we break down the cold, unvarnished economics of owning a housing business. We dissect the hidden capital traps before a tenant ever moves in, the brutal mechanics of debt service coverage ratios, the true cost of room vacancy, and the tax strategies that separate amateur landlords from institutional operators. Welcome to the World Money Desk. To understand why so many individual investors fail in real estate, we have to start from the absolute foundational concept. There is a massive, fundamental difference between owning a house and running a housing business. If you buy a single residential home and live in it with your family, you are a homeowner. You own a personal asset that may appreciate in value over time as the broader market expands. That is a personal balance sheet decision. But the moment you buy a property specifically to rent it out to third parties and profit from those rent payments over time, you are no longer a homeowner. You are running an income-generating commercial enterprise. That enterprise can take many physical forms. It might be a single-family house rented to a suburban family, a small neighborhood building with 8 apartments, or a massive multi-family complex containing hundreds of individual units. The physical scale changes, but the underlying business logic remains completely identical. At its absolute core, a housing business earns revenue by charging human beings for the legal right to occupy a space that you own. The net profit of that business is whatever remains after you subtract your total operating expenses and debt obligations from the total revenue collected. However, the spending side of that basic equation is where amateur investors completely underestimate the reality of the business. Long before a single tenant ever turns a key in a lock, long before you receive a single dollar of gross rent, the capital outlay required to enter the game is staggering. Let us walk through a real-world scenario. Imagine you decide to purchase a modest 10-unit apartment building in a mid-sized, growing city, the exact type of mid-tier commercial asset that feels approachable for a first-time institutional investor. In a secondary market, a 10-unit building in decent condition will easily command a purchase price between $1.5 million and $3 million. Mind you, that is not the cost to build a new property from the ground up. That is simply the baseline seller's asking price for an existing, dated structure. Now, most people understand that buying commercial real estate requires a cash down payment. But, unlike a primary residence where government-backed programs might allow low down payments, commercial lenders view investment properties through a strict risk lens. Financial institutions typically require a minimum down payment between 20 and 30% of the total purchase price. On a $2 million building, that means you need between $400,000 and $600,000 in liquid cash sitting in your bank account just to earn the right to obtain a loan. But the down payment is merely the cover charge to enter the room. Closing costs on commercial real estate transactions add another 2 to 5% of the total loan amount right on top. You are paying lender underwriting fees, title insurance premiums, transfer taxes, government recording fees, and prepaid escrow reserves for property taxes and building insurance. On that same $2 million deal, you must stack an additional $30,000 to $80,000 in pure administrative closing friction. Then comes the physical reality of the building: renovations and capital improvements. Institutional operators who run residential portfolios at scale budget an average of $39,000 per home just to bring an acquired property up to modern rentable standards. For a dated 10-unit apartment building, that number can easily climb higher when you factor in shared corridors, exterior roofing, and utility systems. By the time you have wired your down payment, cleared all legal closing fees, and completed the necessary renovations to make the units livable, you have deployed over $500,000 in cold, hard cash. And at this precise moment, your total historical rent revenue is precisely $0. This is where the financial architecture gets exceptionally dangerous. Because you put down $500,000 in cash and borrowed $1.5 million from a commercial bank, you now have a non-negotiable mortgage obligation due every single month. The bank does not care if your tenants pay rent on time. The bank does not care if the roof starts leaking during a rainstorm. The bank does not care if the national economy is booming or collapsing into a deep recession. To evaluate whether your housing business is creditworthy, commercial lenders use a critical metric known as the Debt Service Coverage Ratio, or DSCR. In simple terms, the debt service coverage ratio measures whether the net operating income of the property is large enough to cover its monthly mortgage debt with a comfortable financial cushion. The industry standard baseline required by almost all commercial lenders is 1.25. That means for every single dollar of mortgage principal and interest you owe the bank, the property must generate at least $1.25 in net operating income after all operating expenses are paid. If your ratio drops below that threshold, the lender considers the loan delinquent and can trigger restrictive covenants. In a high interest rate environment, this mathematical calculation becomes brutal. Mortgage interest rates for commercial investment properties typically sit 1 to 2 percentage points higher than standard residential home loans. On a $1.5 million commercial loan at a 7% interest rate, your monthly mortgage payment alone is roughly $10,000. That is $120,000 every single year in pure debt service, before you have paid for a single emergency maintenance call, a single dollar of property insurance, or a single hour of management labor. That debt never sleeps, it never takes a vacation, and it feels zero empathy if a tenant stops paying rent. Two identical apartment buildings, same physical construction, same age, same number of units can produce radically different financial returns depending entirely on where they sit on a map. Consider two 10-unit buildings. The first building is located in a neighborhood where a major corporate employer just opened a regional facility. The local school district ranks in the top 20% of the state, and the population has expanded by 5% over the last 3 years. The second building is located in a neighborhood where the primary industrial plant shut down 2 years ago. Young working families are leaving, and the local rental vacancy rate sits at 15%. The building in the first neighborhood will almost always remain fully occupied. You can charge full market rents, replace departing tenants quickly, and watch the underlying asset appreciate in value. The building in the second neighborhood is a financial nightmare. Tenants are extremely difficult to find. You are forced to slash rent prices just to attract applicants, and empty units continuously drain your cash reserves. An empty unit is not a neutral asset. It is an active financial hemorrhage. This is why institutional real estate firms spend massive resources analyzing demographic trends, employment diversity, and municipal infrastructure before committing capital. They call this their buy box, a rigid set of geographic and economic criteria a property must meet to earn investment consideration. Selecting the wrong location is a fundamental mistake that no amount of interior paint or expensive kitchen counter renovation can ever fix. The primary revenue engine of any housing business is baseline tenant rent. Every month, tenants pay to occupy your physical space, and that aggregate sum constitutes your gross potential income. But experienced operators do not stop at baseline rent. They build what institutional investors call ancillary income, additional, high-margin revenue streams layered directly on top of the base monthly rent. First, dedicated parking fees. In dense urban markets where street parking is a nightmare, charging separately for assigned parking spots or garage spaces can yield substantial additional income per space every month with zero marginal cost. Second, pet fees and pet rent. With roughly 70% of residential renters owning pets, charging a monthly pet rent of $50 to $100 per animal, combined with a non-refundable upfront deposit, generates significant ongoing revenue while offsetting the physical wear and tear animals cause to flooring and doors. Third, storage space monetization. Converting unused basement space or utility rooms into secure storage lockers allows tenants to rent extra space for $30 to $80 a month. Fourth, ratio utility billing systems. In older multifamily structures where water and electricity run through a single master meter, novice landlords pay the entire utility bill out of pocket. Sophisticated operators implement a legal billing system that divides total building utility costs among all residents based on unit square footage and occupancy. Studies prove that passing utility costs to tenants not only recovers massive operating capital, but also reduces overall water and power consumption by up to 18%, as residents become far more conscious of their usage when paying out of their own pockets. Fifth, furnished rentals. Offering fully furnished units in high-demand urban centers can command a premium of 10 to 30% over identical unfurnished apartments, rapidly paying back the initial furniture expenditure. A sophisticated housing business does not rely on a single income stream. It operates 5 or 6 revenue streams running simultaneously under one roof. Now let us analyze the capital flowing out of the business. The single largest ongoing operational cost is debt service. But right behind your mortgage lies a relentless list of recurring operating expenses that drain cash flow every month. Property taxes are non-negotiable government assessments based on the assessed value of your real estate. In a typical American city, annual property taxes on a $2 million income property can easily run between $30,000 and $50,000 every single year. Property insurance requires special commercial landlord policies, known as DP3 policies, designed specifically for non-owner-occupied buildings. Standard homeowner insurance is completely invalid here. For a multi-family building, or any property located in coastal states like Florida, Texas, or California, where natural disaster risks are elevated, insurance premiums can range from several $1,000s to well over $8,000 annually. Property management overhead is another major factor. Unless you plan to personally answer tenant emergency calls at 2 in the morning, handle plumbing disasters, and personally show vacant units to prospective applicants, you must hire a professional property management firm. The industry baseline fee is 8 to 12% of total collected rent. On a building generating $15,000 a month in gross rent, management fees eat up roughly $18,000 a year. Maintenance and physical repairs are inevitable. Everything inside a building eventually breaks. Plumbing pipes leak, electrical breakers blow, appliances fail, roofs age, and landscaping requires constant upkeep. Institutional operators use a standard budgeting rule. Set aside at least 1% of the property's total structural value every year into a dedicated maintenance reserve. On a $2 million building, that is $20,000 a year. And a single major structural failure, such as a ruined commercial roof or a blown central boiler, can cost $30,000 to $50,000 in a single afternoon. Every single day a residential unit sits empty, your potential revenue vanishes forever. This is the core concept that institutional real estate firms obsess over. If your 10-unit building charges $1,500 a month per unit, your gross potential monthly revenue is $15,000. But if a single apartment sits vacant for 30 days, you lose $1,500. You cannot retroactively collect that money next month. That revenue is permanently destroyed. At that price point, a vacant unit costs you $50 every single day it sits empty. Furthermore, vacancy rarely occurs in a vacuum. When a tenant moves out, you incur turnover friction. You must deep clean the unit, repaint walls, repair damage, relist the property, conduct tours, screen applicants, and execute a new lease. Property management data reveals that the total average cost of a single tenant turnover ranges between $3,800 and $4,000 per unit when combining lost rent, cleaning, advertising, and leasing agent commissions. This is why tenant retention is paramount. Keeping a qualified, respectful tenant in place for 3 or 4 years is infinitely more profitable than pushing aggressive annual rent increases that force them to leave, triggering thousands of dollars in turnover friction. Here is a brutal truth that rookie real estate investors learn through painful experience. A bad tenant costs far more than a slightly lower rent from a good tenant. The absolute worst-case scenario in a housing business is not a market downturn. It is a tenant who stops paying rent, refuses to vacate the premises, and forces you into a formal legal eviction process. Evictions are neither fast nor cheap. The timeline from the first missed rent payments to the moment a sheriff legally removes a non-paying tenant typically takes 2 to 3 months in landlord-friendly jurisdictions. In tenant-protective states like California or New York, the legal process can drag on from 6 months to well over a full year. During that entire period, you receive zero rent from that unit. Yet, your mortgage payment remains due, your property taxes accrue, your insurance premiums continue, and you are paying thousands of dollars in legal retainers to real estate attorneys to navigate court proceedings. Court data indicates that the direct legal fees and administrative filing costs of a standard eviction average $3,500. When you add 3 to 6 months of completely lost rent, ongoing utility coverage, and the inevitable physical destruction caused by an angry evicted tenant, a single bad tenant can easily cost a housing business between $7,000 and $10,000 in direct losses. To mitigate this existential risk, professional operators enforce rigorous tenant screening. The standard baseline is the 3 times rule. A prospective tenant's gross monthly income must equal at least 3 times the monthly rent. Beyond income verification, operators run comprehensive credit checks, verify employment tenure, review rental history with previous landlords, and search judicial records for prior eviction filings. Every hour invested in upfront screening saves thousands of dollars in legal disaster down the line. While the operational and legal risks of a housing business are severe, real estate possesses one of the most powerful wealth-building tools ever created: institutional tax strategy. Under United States tax law, the federal government permits residential investment property structures to be depreciated over 27.5 years. This means you can deduct a portion of the building's physical value every single year as a paper operating expense on your tax return, even while the physical asset is actually appreciating in market value. On a $2 million property where the physical structure itself is valued at $1.5 million, your annual depreciation deduction is approximately $54,000. That is a $54,000 expense that appears on your tax return to offset rental income, without a single dollar actually leaving your corporate bank account. This paper deduction frequently reduces your taxable rental income to zero, allowing you to retain cash flow completely tax-free. Beyond standard linear depreciation, sophisticated real estate investors utilize cost segregation studies. Specialized engineering firms analyze the property to break down its physical components, reclassifying items like carpeting, appliances, exterior lighting, and parking pavement into accelerated 5-year and 15-year depreciation schedules. Under federal tax provisions, these accelerated assets can often be written off rapidly in year 1, generating hundreds of thousands of dollars in upfront tax savings that can be immediately redeployed into acquiring your next asset. Now, let us perform a forensic financial autopsy on our hypothetical 10-unit apartment building and look at the real numbers with complete transparency. Suppose your 10-unit building collects $1,500 per unit in gross rent every month, totaling $180,000 in gross annual revenue. But gross revenue is not profit. It is merely the starting point. First, subtract a standard 5% allowance for vacancy and credit loss, representing routine tenant turnover and uncollectible rent. That reduces your effective gross operating income to $171,000. Next, subtract your recurring operating expenses. Property taxes eat $40,000. Building insurance takes $10,000. Property management fees at 10% absorb $17,100. Maintenance and repairs take $20,000. Landscaping, common area utilities, pest control, and administrative legal expenses cost another $10,000. Total operating expenses come out to $97,100. Your net operating income, what the building earns before paying its bank mortgage, is $73,900. Now, subtract your annual commercial debt service. On a $2 million purchase price with a $500,000 down payment and a $1.5 million loan at 7% interest over 30 years, your annual mortgage payments equal roughly $119,800. Subtract $119,800 in debt service from your net operating income of $73,900, and you arrive at your final year one cash flow, negative $45,900 per year. That is not a calculation error. At current interest rates, a professionally managed, fully occupied 10-unit apartment building purchased at full market price in a mid-tier city can easily yield negative $45,900 in net cash flow in its first year. The math simply does not work unless you put significantly more equity down up front, purchase the property at a massive discount below market value, or execute an aggressive value-add strategy to raise rents and slash operational inefficiencies. So, why do institutional investors continue to acquire real estate if year one cash flow can be negative? Because unlike stock dividends or corporate bonds, monthly rent payments perform a critical function. They amortize your mortgage debt. Every single month, a portion of that tenant rent payment goes toward reducing the principal balance of your bank loan. The tenant is paying down your debt, not you. Over time, the loan balance shrinks, your property equity expands, and that accumulated equity belongs entirely to you. On a $1.5 million loan, approximately $35,000 of your first-year mortgage payments go directly toward principal reduction. By year 10, that annual principal reduction accelerates to over $50,000 a year. Over a 30-year timeline, the mortgage disappears entirely, leaving you with a fully paid-off, multi-million-dollar physical asset that was financed step by step by your tenants over 3 decades. Furthermore, residential real estate historically appreciates at a rate that matches or exceeds broader inflation. Federal Reserve historical data shows that American residential real estate values have roughly tripled over the past 30 years in real terms across major metropolitan markets. Combined with depreciation tax shields, real estate is not an instant cash flow gimmick, it is a long-term equity compounding machine. When operators decide to scale from one building to a massive portfolio, successful investors implement infrastructure centralization. Instead of buying scattered single-family homes across an entire state, they concentrate on multi-family apartment complexes within tightly defined geographic zones. Concentration creates massive operational leverage. One full-time maintenance technician can service 50 units in the same zip code. One property manager can oversee an entire complex on-site. Building insurance can be bundled under master policies, and commercial lenders offer superior loan terms for large, stabilized multi-family assets. At the end of the day, is owning a housing business worth it? The honest answer is that real estate is extraordinarily lucrative for operators who treat it like an aggressive, highly disciplined business. It is worth it for those who model their financing conservatively before signing purchase agreements, screen tenants with surgical rigor, maintain structural assets proactively, retain deep cash reserves for sudden capital expenditures, and build professional management systems as their portfolio expands. It is a catastrophic financial trap for those who fall for the social media myth of passive income, who undercapitalize their acquisitions, who buy in declining locations, chasing high cap rates, who ignore maintenance until roofs collapse, and who fail to understand local landlord-tenant law. The gap between the real estate investor who builds generational wealth and the amateur investor who loses everything in a foreclosure sale is not luck, it is preparation versus very expensive real-world tuition. That is the housing business. Not a mailbox full of passive checks, but a complex, highly rewarding financial operation that enriches those who master its mechanics and exacts a brutal toll on everyone else. Thank you for watching this episode of the World Money Desk. If you want more institutional-grade breakdowns of the hidden financial system shaping the global economy, make sure to hit the like button, subscribe, and drop your thoughts in the comments below. We will see you in the next documentary.